If you actively research in Dubai market, for sure you keep hearing this.
By Ras Al Khaimah, Marjan Island, where this land is considered as a gold.
Why Ras Al Khaimah should be on your radar for your next real estate investment.
Marjan Island, which is located in Ras Al Khaimah.
Do you know why? Al Maktoum International Airport.
It's Dubai South, particularly areas near Al Maktoum International.
Dubai South, because Dubai South is the future.
Maritime City, around $900 per square.
Now this is why you need to invest in Dubai Maritime City today.
Reasons why Dubai Maritime City is a gold mine for investment. So are these three areas, Dubai Maritime City, Dubai South and Marjan Island and Ras Al Khaimah, are really golden mile for property investors, or all these promises are not more than just marketing hype and speculations? Let's find out in this video. During this video, we'll take a closer look at each one of these areas and we'll compare what is promised in the marketing pitch versus what it is in reality. Let's start from the Dubai South.
Everyone is talking about Dubai South, Dubai South. Why Dubai South? World's largest international airport is coming to Dubai South. And you know, downtown, Business Bay and Dubai Marina is fully packed. Ready property and high prices. In Dubai South, new constructions are coming, low prices. So for high capital appreciation, Dubai South is the future.
For the first time, Dubai South came to the spotlight just before Expo 2020, and for the past 2 to 3 years became one of the most overhyped areas, advertised as one of the most promising areas for investors. So let's have a look at the marketing pitch and what is promised. Future of Dubai, part of Dubai Urban Program 2040, infrastructure, greenery, more than 1 million jobs to be created, and more than 1 million residents to be attracted to live and work in this area. Airport, Expo City Exhibition Center, and the metro line to be built here. So if we take a look at the transaction data, we will see that at average, townhouses in the Mar South made tremendous 114% growth. However, this is valid for all other villa communities, because as we know, back in the end of 2020, the market trend has changed and overall property prices in Dubai have grown at least by 60%. While due to undersupply, villa and townhouse communities showed double and even triple digits of capital gain. So that clearly shows that this is not the area that overperformed, but this is the general market trend that apparently is going to its end, and most probably the market will go through some stabilization and even correction in some time. So let's have a look at the real picture. Number one, the gap between developers' prices and resale prices in the area. In Q3 2025, the average transaction price for apartments in Dubai South is around 1,019 dirham per square foot, while current developers' prices, Ellington, Emar, Dubai South, and so on, are launching the projects at 2,000 to 2,400 per square foot. Yes, Dubai South Expo area is priced higher than other areas of Dubai South, but for example, let's take a look at Azizi Venice, that is not located within the Expo. So while apartments in the Mar South are selling between 1,350 per square foot all the way up to 1,700 dirham per square foot, Azizi Venice is selling at 1,800 dirham per square foot, in comparison to 1,019 in the secondary market. Meanwhile, new villa launches in the area start from 1,300 to 1,400 per square foot, with handover in 2028 to 2030. And you can get the same price in the secondary market, and you don't have to wait for 3 to 4 years. For comparison, more centrally located and more established community, the Mac Hills estate, sells on the secondary market at 1,270 dirham per square foot. That for me makes Dubai South prices absolute nonsense. The outcome, it means that today you're buying from the developer at the prices that are slightly higher or equal to the current market value. It means to be able to profit at the exit, the market has to grow significantly, which is very uncertain. Number two, the promised rental return doesn't match the reality. For example, a Mar South 3-bedroom townhouses with average annual rent of 1,013,500 dirham, an average sales price at around 2.35 million dirham, generates around 4.6% net ROI. which is the average or slightly below average for similar type of properties. Let's take the same example for comparison. Mac Hills 1, for example, in Park Residences 1, will generate 6.2% net rental yield. Some might debate saying that, well, MR South is still relatively new and the rent will keep going up as the area matures. However, we are talking about current situation while you're paying the same price and getting lower ROI, which only makes sense when you get a higher capital gain, which is very unlikely for Dubai South. For apartments, let's take as an example Majestic Residences 2. With average sales price of 550,000 dirham for a studio and average size of a studio 400 square feet, rent is between 40 to 45,000 dirham a year. Let's deduct the service fees and it comes down to 7.1% net ROI, which is okay and realistic in comparison to 8 to 10% what the marketing people promising. So realistically, forget about these figures in Dubai South. You will never get them in reality. Number 3, long construction period and delivery wave risks. Around 2027, a large amount of units is expected to be delivered across the most affordable communities in Dubai, and Dubai South is one of those. Supply historically puts pressure on both sales and rental prices everywhere, especially when it comes to apartments versus family homes, which are extremely undersupplied. Again, area development plans, we're talking about exhibition center moving here from WTC, shutting down the Dubai International Airport and moving all the operations to the new Al Maktoum Airport. It will take another 5 to 6 years, while entire area development will be completed within not less than 10 years. Number 4, the future airport story is already priced in. Expansion of Al Maktoum Airport is planned and approved and on the go. However, it will not be fully completed before 2030. Plus, the most important, the future airport narrative hub is already included in today's prices. So treat this as a sales narrative, not the base cases. Number 5, airplanes noise. There is a credible reason to believe that some launched or future projects in Dubai South will be more exposed to airport noise than the others, especially villas and townhouse plots that are closer to the airport boundaries or lower elevation zones. Some believe that the active flight corridors are designed in such a way that they don't fly over development zone. But again, this is all an assumption. It's not backed up by any airport government authorities. And number 6 is micro risk connected to the market cooling expectations. Some analytical agencies, for example Fitch, expect a market correction of at least 15% by late 2025-2026 due to extreme oversupply. Every time a correction occurs, it tends to affect the most the outer areas, mass market areas, such as Dubai South, where the property volumes are high, but the demand is more price sensitive. So conclusion, why investors will not earn what they're promised. Number 1, buying at inflated prices while rental return remains low means weak returns and dependency on the future market appreciation, which is very debatable. Number 2, long delivery period and high volume of upcoming units, which means a high risk of sales and rental prices compression by 2027. Number 3, airport-driven hype is already factored in, and real payoff, if any, will take at least a decade. And number 4, possible market correction will hit the oversupplied and mass market areas first. Practical takeaways. If you still consider Dubai South for investment, focus on resale units rather than overpriced new launches. Prefer handovers between 12 to 24 months to reduce the time risk. Calculate the rental yield as per today, not the promised marketing rental yield. Always run a stress test. If the property prices will drop by 10 to 15% and the handovers delay from 6 to 9 months, will your investment still hold up? Now let's make a skeptical analysis why Dubai Maritime City might be overpriced, might underdeliver on the resale value, and might provide significantly lower rental yields in comparison to what's promised.
The world of real estate, nothing appreciates like waterfront properties, delivering the strongest returns year after year. Just minutes away from DIFC, downtown Dubai, Dubai Maritime City is becoming one of the most sought-after waterfront communities in the city.
Let's go through some warning signs, key risk, and overpricing drivers. Number 1, low rental yields. You can hear promised yields of 10, 12, and even 15%.
Oh my!
First of all, marketed yields always assume premium units, fully furnished units, and full occupancy, which is very optimistic. Property Makler notices that Dubai Maritime City has one of the lowest cap rates among the Dubai districts. Low cap rate implies very high sale price in comparison to rent. a red flag for undervaluing downside risk. Number 2, high competition, demand mismatch, and limited tenant base. Dubai Maritime City represents high-rise towers located along 2 lanes. Dubai Maritime City appeal to the tenants is more niche. The front, maritime professionals and lifestyle seekers. It's not yet a broad residential magnet such as downtown, GLT on Dubai Marina. Number 3, speculative prices ahead of market fundamentals. Developers and salespeople justify high price per square foot based on future expectations, using such terms as waterfront, premium, marina lifestyle, scarcity, and so on, rather than current demand and cash flow. Well, maybe master plan project by Beyond will outperform single buildings by random developers, as it provides community-like feeling and united infrastructure. But the value for money is still debatable, taking into consideration a high price per square foot. If we compare Maritime City to the neighbor community of Dubai Islands, which is also not a single master community by one developer, but unlike Maritime City, it has a very structured master plan in place. And this master plan is way more interesting and diverse, featuring amazing connectivity, golf courses, shopping mall, school, hospital, and the most important, the beach, which is natural in comparison to what Beyond is building in Dubai Maritime City, which is technically a lagoon, a swimming pool type of beach. Some units might face suboptimal layouts, limited views, shadowing, or lower flows being too close to industrial or maritime operations. So developers here are focusing mostly on the views because the lifestyle here is very debatable. Versus in comparison, for example, again, Dubai Islands, where views are secondary while lifestyle is primary, something that brings real value. Number 4, industrial component. The dry dock marine service facilities are most likely to stay and continue serving the marine industry in the area. While this point might be debatable because certain people might find it attractive to live next to the port, in my opinion, it doesn't complement the luxury lifestyle that is actively being promoted in Dubai Maritime City. Number 5, connectivity. There is a very interesting speculation about the direct metro access to Dubai Maritime City. However, nothing is yet confirmed publicly and no official route maps that are showing Dubai Maritime City metro station. Number 6 is data manipulation. Developers and salespeople are actively pointing out sales transactions in the area. However, there is no resale data. It means that the early sales in the area might just reflect the investors' hype rather than organic demand. Bottom line, why resale prices and rental yields might disappoint investors in the Dubai Maritime City when the hype goes down. The promised premium is already in the sales prices. The water scarcity project narrative is actively used by developers promoting Maritime City. However, it has to come with a fair price per square foot, which is not the case for Dubai Maritime City. Short-term rent speculations. High competition in the area plus overall short-term rental concept going actively down might disappoint the investors. Now let's talk about my favorite overhyped area, Ras Al Khaimah.
Near Al Marjan Island, nothing else will compare. Al Marjan will erase everything you have seen so far. It's not just next level, it's a new destination.
Honest opinions about investing in off-plan in RAC?
Risky. I think if you want to take that risk, then take it. But I think it's all built around the casino, and I think when Dubai, well, if they prove the concept on casinos, Dubai will follow. They've already got plans, and I think that will make RAC back to being a fishing village.
Las Vegas of the Gulf, Marjan Island is on fire. Projects around upcoming casinos sell like there is no tomorrow. But is this hype really justified, or is it just another investor trap like Expo 2020 before? There are lots of examples when casinos really became a game changer and, for example, turned a small town of Las Vegas into a world-famous gaming resort and into one of the most popular touristic hubs. But remember that at the same time it brought crime, money laundering and addiction concerns, which is, as you understand, is absolutely a no-go for the country like UAE. Plus, you need to understand that Las Vegas grew organically from the domestic tourism, while Ras Al Khaimah is solely dependent on the international tourism flow. Plus, while Las Vegas thrived on the competition between multiple operators, Ras Al Khaimah will remain centrally controlled and limited in scale. For anyone who ever visited Ras Al Khaimah, it sounds super funny when people are comparing it to Las Vegas or Monaco.
Oh, are you kidding me?
Well, there are also mountains in Nepal, but it doesn't turn it into Switzerland. Developers and media continuously talking about future growth, high yields, tourism, demand, etc. So the casino hype essentially is Marjan will become a luxury tourism resort and a luxury waterfront residential development, rivaling up the top destinations in the UAE. A strong investment play now to benefit later. Well, my observation is that the majority of investors buying properties in Ras Al Khaimah on the hype are international and have even never visited Ras Al Khaimah before. So after the hype goes down, the investors will have to deal with the post-euphoria reality, which is far not as glamorous as the marketing promises. So let's take a closer look at the reality. Liquidity and resale risk. Many people note that reselling a secondary market property in Ras Al Khaimah in comparison to Dubai and Abu Dhabi is way harder. Less mature market, fewer buyers, weaker infrastructure and economy. For example, in some forums like Reddit, people say that if things don't happen in Ras Al Khaimah, you are stuck with the unit, which is going to be super hard to liquidate. So if you buy now, hoping to resell later, you might find no buyers or will be only able to sell at a much lower price. Next risk factor. Properties are overpriced based on marketing hype, not the real base. Some critics say that properties in Ras Al Khaimah being priced like top luxury communities in Dubai, Dubai Marina, Palm Jumeirah or downtown. But those areas have decades of infrastructure, demand, brand connectivity, things that Marjan Island is still lacking. So the risk is you might be paying for promises, not what is actually delivered. Next risk factor is that the infrastructure and amenities are not yet mature. Because many projects are still under construction, not all what is promised, public infrastructure, transportation, retail services, may be fully in place by the time of completion of the first project, which means that the real living experience may fall short in comparison to what is promised. Next, tourism demand volatility. The success of such destinations as Marjan Island and Ras Al Khaimah is solely dependent on the success of touristic industry, favorable macroeconomic conditions as well as tourism trends. During the economical downturns or travel slumps, these kind of areas will get hit hard. So rental yield expectations may be too optimistic as they're based on the base case scenario. Next risk factor is reported hotel and hospitality quality issues. There are guest reviews for some existing properties in Marjan Island. For example, weekend from hell, many impolite guests, beach is nothing, pretty bad experience, noisy, not very nice to look at. This suggests that the real experience doesn't always match the glossy image. Next investors' risk is related to uncertainty around gaming regulations in the UAE. The WIN project includes the gaming casino component, which is a complete novel in the UAE reality, with a regulatory, social and political sensitiveness around. Not everybody knows that the license to WIN casino had been granted for only 5 years. What happens after? Nobody knows. Last but not least is connectivity. While not completely remote in comparison to Dubai's central hub, Marjan Island is less connected, has less transportation options, and the most important, has less bars of major urban centers. While for many buyers and investors, accessibility and proximity matters a lot. To summarize, property data suggests a significant growth in transactions, prices, and overall demand to Ras Al Khaimah. But you need to understand one simple thing, and this doesn't only refer to Marjan Island. If the projects sell out fast on the primary market, it doesn't guarantee you future success on the secondary market. While developers are only competing with 2-3 other towers nearby, while all the other projects around are pretty much sold out, and they have all the tools to do that, marketing teams, sales teams, promotions, payment plans, and so on, you will be competing with thousands of other units of the same type in the same location. Whoever happened to visit Ras Al Khaimah will understand that there is absolutely nothing to do there out of the island. While in Dubai or Abu Dhabi, you have plenty of things to see, do, and enjoy. For the investment to be sustainable, the city or the location has to offer a strong economy and other things to offer rather than cement factory and few shopping malls in the city center. Another thing, while tourism in Ras Al Khaimah represents only 5.5% of GDP, while in Dubai from 11 to 20%, then why are the prices per square foot in Marjan Island at the same or even higher than those in Dubai Islands, for example? By the way, many investors do not realize that the broker who pushes them to buy property in Ras Al Khaimah, promising them to resell his unit in the future, will not be able to do so simply because he is registered in Dubai, not in Ras Al Khaimah, because every emirate has its own licensing system. It means that Dubai-based brokers can only sell Ras Al Khaimah as an off-plan. Write in the comments what you think about the hype around Marjan Island and if you agree with me or disagree. Thank you for watching this video. If you found it useful, push the like button and see you in the next videos.